Hello again, everyone. John Flynn here from Flynn Real Estate, serving Southern Ontario, based out of the Niagara region. Here again to give you my honest and professional opinion about the 2022 Canadian housing market. First, before I get into what some people might consider conspiracy whatevers, but it's not, it's going to be all facts today, I want to talk about the beginning of my career. When I first started, I started in 2004. When people bought homes, they bought homes to live in. There wasn't that much investing back then. Any rentals that I sold, it was usually someone had moved in with a partner, at a certain point in their life, and they would keep their house because their partner, husband, wife, whoever it was, had their own place. And they say, oh, I'm going to keep mine as a rental. And then years later, they would say, okay, let's sell it. I want my money. So that was usually the amount of rental properties I dealt with, maybe for the first 10 years. And then once we got to 2013, 2014, 2015 and on, the rental market was pretty active in my business. So again, early years, not so much, and later on is when it took off. A couple of stories about early on in real estate, my experiences. One was before I was a realtor. Have a good friend. So he bought the house, him and his girlfriend, young, early 20s. She didn't work at the time from what I remember. I'm pretty sure she didn't. And he worked at a hotel, didn't make much money. He was kind of a general laborer there. Probably $10 or something an hour, maybe 11. They came into about $5,000. They bought their first house. That was it. $5,000 for the down payment, the closing costs, everything. And he could afford it. He got approved with no co-signers on his own. And they bought the house and, kept it for many, many years. Another one was myself. I actually ended up living with this friend while I was working. Before I was a realtor, I had many other jobs. But anyway, I was doing a job for about a year, saved up enough money, was thinking I'm either going to buy a house or I'm going to change careers, which was start real estate or take my course and start real estate. And I said, you know what? I don't want to do this job. Yeah, I can own a house. The dream will come true for me, but I'm going to be stuck working this job I don't want to do. I had about $10,000 saved up. And I said, you know what? I'm going to take my course. I quit the job and started real estate. Of course, I couldn't do both because I had no income. And then it took me about another year or so to save up the money again from real estate for the down payment or to be able to buy a house. My parents did help me out, but I paid them every penny back. But I could have done it, but I just got a better rate with them and whatnot. So again, help from the parents, even myself, right? But it was possible. One income person could buy a little home and pay the mortgage, right? That was the way it was. So that's where I get into today's situation. And I wanted to touch on it and the progression of how things have gone in the world since even when I started 2004 and just before that with a friend. The friend that bought that house was about 20 years ago now. So I made a little chart. I call this the evolution of the young family. And it just generalizes over the decades how things have changed. So please make a comment if you think I'm severely off base with this, or if you'd like to see if you want to add any changes to it. But this is just a generalization, but it is, somewhat reflective of how things have gone, and hence the title of the video. But again, this is based on, pretty well-known facts, and you can look around, and if you're older, you might realize this. If you're younger, this is the way things happened, and this is the way things are. I broke it down every 2 decades. First is the 1950s. You had one person working in the family, in the young family. They bought a house. They would have a mortgage, obviously, back then. They would probably own one car, only one person working. They would take a vacation every year, maybe 2, but, usually 1 vacation. And they would save some money. Of course, they would save for the vacation, but they would save money. And they had little to no debt other than the mortgage. Maybe they took a small car loan, but usually there was no debt involved. Fast forward to the 1970s. We have 1 to 2 people working. There was more, 2-income households then. They would own the house, they would have a mortgage. They would need 1 to 2 cars, depending if there was 2 people working or not. And they would own the cars. They could afford them, or they could buy them. Sometimes they might get a small loan, but it wouldn't be like today. Again, 1 to 2 cars owned. Vacation, take a vacation every year. And they would save money, whether the money was for the vacation or Christmas or whatnot. And little to no debt. In the 1990s, 2 people working. You would own the house, have a mortgage. You'd have 2 cars, and you'd have payments, at least on one, maybe both. And you'd have, a 5-year payment on it and whatnot. But like I said, at least 1 car. Vacations seem to increase over the years. So I'm going to say two vacations a year on average. Sometimes, mostly one, but I'll say 1 to 2, but let's give it the benefit of the doubt. They wouldn't have much savings, and of course, the debt started with credit cards and the car and the student loans, right? I remember even when I went to college, you know, they give you a credit card when you walk in the door and you leave with your whatever student loans you have, if you had them, and of course some credit card debt too. And fast forward to the 2010s, 2 working people, you would own or rent, depend, mortgage, you'd have a mortgage or rent. And people always rented, but again, it was more common for the younger families in the 2010s. You'd move out of your parents' house. A lot of times you'd rent instead of buying because you weren't able to buy yet. You'd have 2 cars. Maybe you'd have a payment on one, a lease on the other. Leasing became a lot more prevalent at this time. You'd have payments that were stretched longer, maybe 6, 7 years, a lot of times 8 years, but let's call it 7. Again, your lease payment. Vacations, 1 to 2 a year. No savings. Credit card, car debt. Home equity line of credits were big, still are. Boats, student debt. Of course, more debt, less savings or no savings. Now we're going to fast forward to 2030. 2 people working. Renting comes first. In the previous situation, you'd own more than rent. Now you're going to rent before you'll own, or in 2030, I should say. 1 to 2 cars, maybe. Payments will be 8 years. We keep stretching these payments out on the cars. And of course, someone's going to lease a car, so leasing is going to be very prevalent. 2 vacations a year, maybe, if you're allowed to go. No savings, credit card debt, car debt, phone debt. Like a lot of people now, you don't even own your phone, you put it on your phone bill. Computer debt, student, grocery debts. In certain countries, they already actually have grocery. You go to the grocery store and they'll give you an interest-free loan, they call it, but I don't think it's interest-free. But anyway, there are people who go in debt for groceries these days. And of course, utilities. So you can see the natural progression is people owning less, or it's harder to own, or if you do own, it's a longer term payment for your vehicles and whatnot. Little to no savings, and a lot more people renting that don't have the option to buy because you can't afford it. So again, it brings me back to you'll own nothing, but I don't think you'll be happy. I think you'll be miserable. But I do have some good news for all the potential buyers sitting on the sidelines wondering when they're going to be able to buy. So we're going to get into the next article or the next situation, which I got a good few comments on the channel talking about BlackRock came and they bought everything, or they're going to buy everything. They set up an office in Toronto and they're going to buy all the homes, and it's going to make it even harder to afford them. So I just wanted to make a correction for anyone that thought BlackRock came and set up an office in Toronto. It actually wasn't BlackRock, it was Blackstone. They're one of the biggest or the biggest pension funds in the world, and they set up very publicly an office in Toronto or somewhere near Toronto or in Ontario somewhere with the intention of diversifying for their pension fund and buying real estate. Now, it seems like they're sticking more towards multifamily and commercial/industrial real estate, but I just wanted to say, like, it wasn't BlackRock. But just like many other companies, or almost all companies, BlackRock is the second biggest shareholder in Blackstone. So you are partially right. So here is the top 10 owners of Blackstone Inc., Vanguard, BlackRock, Morgan Stanley, and so on. Now, Google top shareholders in any company, any big company, I don't care who it is, Pepsi, Facebook, whoever. So this is where the theory comes for you owning nothing. Who is going to own it? Well, the big corporations are going to own it, and now they're coming after your real estate, supposedly. So just a couple other companies. We have, actually I'm going to get into, RE/MAX was in the one article. RE/MAX Holding Inc., BlackRock, Vanguard, top 2 biggest shareholders for RE/MAX. And of course, and again, any company. Meta, Facebook, Vanguard, and then BlackRock number 3. So yeah, do that. Top 10 shareholders and the company of your choice, and you'll see who they are. So let's talk about that. This is probably the number one threat that people perceive for residential real estate in Canada and especially in the States. So here was an article. This was a pretty good article. It's from CBC. It was just posted August 3rd, 2022. A new phenomenon, big investors eye Canada's home market, RE/MAX president says. Investment firms have become the biggest new buyers of U.S. homes, a trend that can make home ownership more difficult for average families. The idea of big investors buying single-family homes to rent them out is just in its infancy in Canada, but it's worth watching, according to the president of one of the largest real estate firms, who the majority shareholder not in his firm, but in the RE/MAX Franchise Corporation, is BlackRock. Not that he's tied in with them, but it's kind of ironic. As interest rate rise and property prices fall across much of North America, deep-pocketed investors such as hedge funds, private equity giants, and pension managers are hunting for stable assets to offset inflation in volatile stock markets, according to market observers. In the first quarter of 2022, investors made up a record 28% of U.S. single-family home sales, according to a report published in June by the Harvard Joint Center for Housing Studies, compared to less than 20% a year earlier. So again, they're scooping up houses in the States like crazy, these big investment corporation and pension funds. So keep an eye on it. Let's keep reading. As middle-class families increasingly struggle to buy homes, analysts say more capital from large firms is expected to enter the Canadian market, further straining supply and affordability for average people. The Canadian government does not have clear data on the footprint of large investors in the domestic housing market. Neither Statistics Canada nor the Canadian Mortgage Housing Corporation, CMHC, federal agencies which track the sector, could say how many homes are owned by investment firms. I think they should probably start tracking that, like ASAP. For the moment, Statistics Canada does not publish information on institutional investors and the type of residential properties they own, a spokesperson for the government organization told CBC News via email. CMHC does not collect the data that you are looking for, a spokesperson echoed. Yeah, I think they should start for real. The question of not knowing. The Canadian Real Estate Association, the trade body representing brokers, declined to comment. So did Royal LePage, a major brokerage. Two other property agencies, Century 21 and Keller Williams, did not respond to interview requests. I don't know if they didn't comment because they didn't have the information or they don't want to disclose privacy information, but we're not looking for names, we're just looking for general statistics, but something that we got to watch. Blackstone, which describes itself as the world's largest alternative investment firm with billions spent on single-family U.S. homes, opened a real estate office in Toronto in May to expand on its $14 billion in Canadian real estate assets. We expect to continue to be very active in the Canadian market, particularly in areas like logistics, high-quality creative offices, and life sciences offices, studios, and multifamily residential, a spokesperson for the company told CBC News via email. We continue to have no intention of investing in the single-family housing market in Canada. So interesting that they specifically said they're not interested in the single-family housing market. But that's just Blackstone. There's many other firms that are probably eyeing the Canadian market, just like in the US. So again, keep an eye on this. Blackstone owns approximately 0.02% of single-family homes in the US, according to company data, accounting for roughly 25,000 units. Given our ownership levels, we have virtually no ability to impact market rent trends, Blackstone said in March in an online question and answer session responding to criticism. Rents are going up because there is significantly less supply of housing across the globe than demand for it. U.S. realities. Private equity investors in the U.S. started buying up single-family homes following the 2008 subprime mortgage crisis and ensuing recession, said Barrett of the Canadian Urban Institute. But the trend did not catch on to nearly the same degree in Canada. Since then, corporate landlords have acquired an estimated 350,000 homes, according to testimony heard by the U.S. House Financial Services Committee on June 28th, probing the affordability challenges and private equity. So that was a very important statement right there. The private equity investors in the U.S. started buying up single-family homes following the U.S. 2008 subprime mortgage crisis. So, and the ensuing recession. So they literally started buying when the prices were low. They're not going to buy now. They're going to buy at the recession point. So when they're buying, you should be buying. By 2030, investors could control as much as 40% of the U.S. rental home market, according to data cited by PERE, an industry journal. Aside from fears about deep-pocketed financiers outcompeting regular people to buy homes, tenants renting from big investors have faced a slew of problems, said Madeleine Bankson, a researcher with the Private Equity Stakeholder Project, a U.S.-based advocacy group. Poor maintenance, broken air conditioners in the sweltering U.S. South, a lack of garbage collection, mold, exorbitant charges for late payments, and no one to respond when things break are among the problems tenants in houses owned by large investors have reported to advocates. The model is increase revenues, decrease costs, Branson said. Seems like the big investors or the institutional investors are like slumlords by the sounds of it. Of course, they don't want to renovate homes and put new air conditioners. They just want to patch it up or not fix it at all. Some truth to the claims that Blackstone or BlackRock owned Blackstone, setting up office in Toronto and going to scoop up all the Canadian real estate. But it looks like they're not going for the single family. They're looking for more commercial and multifamily apartment building, stuff like that. So not a big threat right now, but they're not going to be buying now. They're going to be buying the homes that people can't pay for. Just like I tell my viewers, you should be buying the homes at that point too, right? So bad news for the greater good of owning things, since corporations are going to own a lot more. And of course, this whole financial crisis has benefited big corporations. Inflation benefits them because they grow their balance sheet and their net worth. And when things go wrong or when they don't go wrong, they have more capital to buy more investments, and some of which are going to be homes. So the good news is it will be worth investing in Canadian real estate for yourself as a single family home. I'm not talking about investment to buy a bunch of homes yourself and get rich. Well, if that's what you want to do, go ahead, but that's why we're at the problem we are now. Whether you follow my advice or you follow these corporations or institutions when they start buying real estate, that is probably the best time to buy, because these guys sink a lot of money into their analysts and will buy at the right time. They're not buying now. They're not buying in a month from now. They're buying when the market drops, when the prices bottom out, and when you should be buying. So we'll keep an eye on these guys, and of course when the signal comes to buy, I'll be the first one to say it. You might see some false flags along the way, and you might see some good real estate sales data, and everyone's gonna say, oh, the market's reached the bottom, John was wrong. I'm sticking to the data, the way I analyze it, and we'll be watching these guys. When they start to pull the trigger, you might want to consider doing the same. So yeah, that's it for that. Next week we're going to have the August statistics, and as always, thanks for watching, and I'll see you then.